and welcome. You're watching BloombergQuint, and you've got the Infosys September quarter numbers flashing there on your screen. And the numbers, at least on the margin front, are looking even better than what the street estimates were throwing about. The EBIT margins for the September quarter have come in at 21.7% vis-a-vis the Bloomberg consensus of about 21.5%. Remember, this is an expansion of about closer to 120 bips that you're seeing on sequential basis. And even on the revenue and the profit front, the numbers are pretty much in line. The EBIT has gone up by about 10%, which is coming at 4,912 crore. But margin number and the guidance which they have given for the entire fiscal now, in fact, they have upped the lower end revenue guidance to about 9% from earlier 8.5%. So for FY20 in constant currency, revenue guidance now stands at about 9 to 10%, but they've maintained their operating margin guidance for the entire fiscal, which they had given in during the first quarter itself, to about 21 to 23%. On that note, let's bring in Trip Chaudhary, who's a managing director at Global Equities Research, who joins us from San Francisco. Hi, Trip. Thanks a lot, by the way, for joining us. What's your first take on the numbers? They clearly surprised the street, even in the June quarter, by upping the guidance, and they've done that again by increasing the lower end of the revenue guidance for FY20. Your first reaction to the numbers?
Definitely, as I've been saying in the past, Infosys has definitely turned the corner. They're executing very well. They have invested in their own people to build new capabilities and to go for the deals which are less price competitive, and they are more value add. So that is reflected in the expanding margins, and that is also reflecting in the upping the guidance. So this clearly indicates that Infosys has the handle on the situation, and I think they're executing very well.
Trip, in fact, the digital, revenue has grown almost 38% on year-on-year basis, and this I'm talking in constant currency. So that too has given you good growth, at least on year-on-year basis. Dollar revenues are up about 2.5%, pretty much in line what the street was expecting this time around. But the big number, the other number actually what the street was watching out were the deal signings. The only silver lining, Trip, which came in TCS numbers were the total contract value which they had signed for the September quarter. For Infosys, it is at $2.8 billion for the September quarter. Your take on that? Is it in line with what the street was expecting? Is it a good number?
I think it is more than what we are expecting, but it also validates the situation that we are seeing at the global macro level. What we are seeing is a global slowdown. When the global slowdown happens, companies go for flexible workforce which has very strong capabilities and good numbers from Infosys. And I think if you think long term, at least over the next 3 to 4 quarters, I think TCS numbers will also improve. Because as I mentioned, when you have a global slowdown, people are not looking for permanent employees. What they're looking for is, I have this specific project which will last for about 8-12 months, and I want to put the best people on it in the most flexible manner. And that's exactly what all Indian IT companies really shine. So I think good numbers for Infosys is also validation that there is a global economic slowdown. And it's positive for Infosys.
Right. In fact, TCS numbers were a disappointment on all parameters, be it on the revenue front or, for that matter, EBIT margins, which came in at 9-quarter low. And you spoke about the slowdown that we've been seeing, the BFSI vertical, Trip, which is very important for these companies. There's been a slowdown seen there in past many quarters because of the slowdown we've seen for a couple of these European banks. The capital markets for them have not been doing that well. First half is seasonally strong for these companies, and second half not so much. So do you think going into the second quarter at a time, second half of this fiscal year, when there is some bit of slowdown seen in the American market and also in the European market, the performance in second half could be tepid?
See, if you look at what is happening in the capital markets, the startup bubble is bursting. All the bullshit companies that went IPO, for example, Uber, Lyft, these are the ride-sharing gig economy. There's a lot of hot air that is getting busted as we speak. WeWorks, you name it, Zoom video. There was a lot of just like in 99, useless companies going public with no path to profitability. When your IPO market is based on thin air, the companies cannot remain afloat for long, and that reflects in the capital markets as a client. But the beauty of many Indian companies, even though 30+% in some situations revenues for Indian IT services come from the clients who are in the capital markets. But the good thing is, at least for Infosys, that I follow very closely, is they have a lot of skills that even capital markets require. For example, digitization of your existing operations. Even though the revenue fall can happen, but they are going to do a lot more through offshoring and outsourcing versus in-house. As you can see, capital markets are laying off people, but the businesses still need to run. Who will make sure the lights are on? These are our companies like Infosys, Wipro, TCS who will do that. So just to summarize it, the startup bubble is bursting. Companies built on thin air cannot remain afloat, and companies who are built on some stupid concepts like gig economy and companies like Uber, Lyft, and the whole BS companies, they are bursting. And I think it is very positive for Indian ITC companies because they are focused on providing core values, not hot air.
Okay, and the other key metric actually which we look at very closely for these companies is the attrition rate. And remember, though Infosys outperformed in the previous quarter, their attrition rate was pretty high at about 21.5%. But this time around, as the commentary comes in from the CEO and MD Salil Parekh, he's clearly said there were large deal signings, operational efficiencies, the operating margins improved because of that, and there was some bit of reduction that also came in the attrition rate. Finally, Trip, before we thank you, what's the call, or rather what would you advise the shareholders of Infosys who are still holding the stock? Should they stay put? Because we've seen outperformance in the stock vis-a-vis the Nifty IT index, at least from the first quarter earnings.
I would say today is the time you have to invest in the companies based on solid technology, solid services, singularly focused on the customer. That's the only reason investors should be holding Infosys. Investors should not be chasing conceptual companies in the startup world. Startup world is over. Silicon Valley companies are getting busted. They're because of zero value they are providing other than concepts. The same situation is going to happen in India. All these startups are going to blow up. The companies that will remain for multiple years and probably decades are companies like Infosys, TCS, Wipro. So I would say invest. We have a price target of $14 on Infosys, a great company to own.
All right, Trip, we leave it at that note. Appreciate you joining us today and taking us through your take on the September quarter numbers of Infosys, which looks like a slight beat, at least when it comes to the EBIT margins. Remember, two key metrics were the margins, which the street was watching, and the guidance they were watching out, whether they will once again up the guidance or not, which they have done. They have upped the lower end of the revenue guidance for FY20 from 8.5% to 9%. We're also joined by, I think we'll get Harit Shah in a while. I think he's there with us. Harit, hi. Good evening, rather. Thanks a lot for joining. Your first take on the numbers.
Yeah, I think a pretty good set of numbers. I would say at best it was, I think, an inline quarter. I don't think there was one good thing was that there was no major negative surprise, in this quarter. Maybe marginally lower revenue as per what we were expecting. We were expecting 3.5%. In CC terms, they did 3.3, but apart from that, I think there's nothing to, major to complain about. The interesting thing was that financial services revenue grew at a faster pace than the company average. Although that was, I think, aided by Stater acquisition, but we obviously wait for some further comments as far as BFSI and retail are concerned. But I think one positive thing was that margins were above expectations. So after quite a while of investments, investment mode, finally the company does seem to have started to see some sort of benefit from those investments now. So I think that is an important factor to watch out for. They maintain their band, as far as guidance is concerned. That I think sustainability of this, at least 21.5% to 22%. That is something we will watch for going forward.
Okay, Harit, historically, Infosys has been quite conservative when it comes to guidance, and last 2 quarters now they've been upping it. Do you see any chance, considering the outperformance to TCS now, they can outdo the guidance that they've given?
No, so see, we had factored in growth in excess of 10% in April itself when they had given at the start of the year when they had given out their guidance for FY20. And not unexpectedly, they increased the guidance in the last quarter. They've marginally increased it this quarter, although you cannot technically say they've really raised their guidance. It's just a small increase at the lower end of the band. But, I think they should comfortably achieve double-digit growth without any major problems in this fiscal year. The first half has been, pretty decent. They achieved, I think, more than 12% CC growth in the first quarter year-on-year. And this quarter is about 11.4%. So I think double-digit growth should not be a major issue, even though we may consider that the second half is seasonally weaker because of, holiday season and lower number of billing days. Even considering these factors, I think they should easily beat their guidance for the year.
And the discount which everybody was talking that it trades to TCS, I think that's been bridging post Q1 numbers. We have seen outperformance when it comes to the stock of Infosys. Do you think that's likely to continue? What's your target on the stock?
No, so they've. I think now the valuation gap is more or less vanished now. It's more or less equal now. I think they're trading at almost very similar, kind of a multiple at the moment. Very, very slight. I think TCS is maybe trading at a slight premium, but not substantial. So, given that they will grow at a faster pace than TCS, it's possible that this valuation gap may further, get compressed, and at some point maybe Infy could also trade at a kind of a premium to TCS going forward.
Okay, Harit, we leave it at that note. Thanks a lot for joining us and taking us through your take on Infosys number. I think we've got Agam Vakil as well, who tracks this space pretty closely. In fact, he is in Bengaluru at the Infosys campus tracking the numbers. Agam, over to you. What's standing out according to you in the September quarter numbers?
Right, Naveen, so I happen to see, the way Infosys moved in today's day of trade in comparison, how TCS moved. Of course, TCS and the management had already mentioned and made note of the fact that it's unlikely that they will see double-digit growth. That said, given the fact that Infosys has not reduced its upper end of the guidance, that of course comes as a positive, and that makes this earnings well worth the while. That's also possibly the reason why we have seen that up move in today's day of trade. We must remember that this is only the lower end of the guidance which has been up, not the upper end. That said, it doesn't rule out completely a double-digit growth for Infosys. The other heartening part of there here that we may need to note is that the digital CC revenue growth is at 38%, as against several of its peers, in this case TCS at 28%. So there's a beat there. On a year-on-year basis too, in constant currency terms, you're looking at an 11.4% growth. So this, of course, is also something that plays out in favor of Infosys. What I'm going to be keenly watching out for from the management is that how deal flows have come through, and where are these deals coming in, because we're clearly getting some indications about the large financial institutions being under pressure, which may have led to a delay in decision making, and all these other factors with respect to several other large verticals and a lot of volatility in retail as well as manufacturing. So I'm going to be keeping an eye on all these factors, waiting for the management to come through at this point in time.
All right, Agam, we'll leave it at that note, and we'll wait by for the management's press conference also. Thank you for joining us. And talking about the number of clients, by the way, the $100 million plus clients remain the same. 27 were there in June quarter as well, and at the end of September quarter, it's 27. Where the clients have increased, it's $50 million plus. I think by the end of September quarter, it's 61, and June quarter was 59. So 2 clients have been added there, whereas a lot of addition, I think 13 clients have been added when it comes to $1 million plus clients. So I think it's the $50 million and $1 million plus clients where the increase has come by. So net numbers are looking good. A slight bit of beat when it comes to the EBIT margin, upping the guidance from the lower end in terms of full financial year. That's FY20 revenue guidance in constant currency. They've increased the lower end from 8.5% to 9%. And for the year now, the territory that they've given is 9 to 10%. The operating margins guidance, however, is they've maintained between 21 to 23%. Of course, as Agam highlighted, we'll be watching out for some key commentary as well. They've declared dividend of about 8 rupees per share. Remember, TCS declared special dividend of 40 rupees. So capital allocation policy going ahead will be key, whether they announce any sort of buybacks or no. They've announced dividend, but what's going to be the capital allocation policy going ahead? We'll be monitoring all of those comments which come from the management. But on that note, thanks a lot for watching. This is BloombergQuint.
And welcome to everyone that's here. We are really delighted to share with you the results for our second quarter. You've hopefully seen the press release and the fact sheet. But just to give you a few points as we kick it off, we had a really strong, robust quarter in Q2 with good performance all around in all of our parameters. First, we had double-digit growth now for the fourth consecutive quarter, 11.4% constant currency growth overall, and 38% constant currency growth in our digital portfolio. We also had a very strong operating performance. Our operating margin was at 21.7%, 1.2 points expansion from Q1. Many of the operating parameters and discipline are kicking in, and this is what's being seen in the operating margin performance. Very good, strong, large deals performance, 2.8 billion in large deals, and we've shared that data in the press release and fact sheet. Very good movement on attrition. It's reduced by 2 percentage points. And in fact, in the way we look at attrition, as we measure it on our tech services business on a voluntary basis, that's already starting to be below 18%. So overall, we are really delighted with the results we've had in Q2. We're also extremely proud in that we were awarded by Forbes the ranking number 3 for the best regarded company globally. And it's something all of us at Infosys are extremely proud of, a testimony to all the hard work of our people and the support of our clients. With that, I'll pause and open it up for questions with Praveen and Nilanjan here with me.
Thank you, Salil. Before we start the Q&A session, I would request you to ask one question per publication. The first question is from BloombergQuint.
Hi, Salil. I'm sure investors will be relieved to know that you maintained your upper end of the guidance, especially when one of your peers has indicated that they are unlikely to see double-digit growth. That said, well, I want to get a better understanding of how you're reading things currently, because there is still an indication that large financial institutions in the UK, Europe, as well as US are under a bit of pressure. And there is understanding that well, there's a slowdown in demand, and that could lead to delay in deal closures. That's as far as the financial sector is concerned. There's a lot of volatility in retail, which persists. And communications, again, there is still delay in allocation of the 5G spectrum. I believe that a lot of that is pegged on that. I want to know that even when you do see well, a relatively steady financial year, FY20, if you could tell us a little more about how you're reading into things when it comes to, well, things on ground. Praveen, a question for you on the deal signings. If you could actually tell us a little more about the size, the duration of the deals, also in what verticals are a majority of these deals coming as far as this quarter is concerned. And Nilanjan, for you, if you could actually quantify some of the factors that have come and played in favor of margins and played against.
Let me start with a color on the business and how we see what's going on in the market. First, 6 of our 7 large segments are all showing double-digit growth for Q2. We see a good traction, for example, if you look at energy utilities business, an extremely strong environment in that business. If you look at what we're doing in a high-tech telco business, again, an extremely strong environment in that business. To now come to financial services, we had a good growth in financial services in Q2. We see good demand. As we had pointed out last quarter, there is certainly some weakness that we saw in capital markets. And in general, there is something where the financial institutions overall are looking at spend differently. But for now, we see a good demand in Q2, a good outcome in Q2, and we will see how that plays out for the rest of the year. In terms of telco, we see a very strong demand, so I have no view that it's any different from what we had shared with you last time. We shared some weakness, which was very specific to manufacturing last quarter for the European segment. We see Europe as a geography a little bit softer, but overall manufacturing is in a robust place for us today. There's the view from a macro perspective is that the European market is somewhat slower. We see some impact of Brexit, but nonetheless, we maintain our guidance, which in fact, we increase the lower end of our guidance. So from 8.5 to 10, we increase to 9 to 10. So we remain quite confident in how this year will play out.
On the large deal front, we won 13 large deals at 2.8 billion TCV, highest ever. And for the half, when you compare on a year-on-year basis for the first half, our large deal wins TCV has been 75% higher than what we did same period in the first half of last year. This has been broad-based. 4 of the wins have been in financial services, 4 in retail, CPG and logistics, 2 in communication, and 3 in other verticals. Then geography-wise as well, we have seen about 6 in Americas, 5 in Europe, and 2 in rest of the world.
Yeah, so coming to the margin question, I think as we started the year on a low trough of 20.5%, I think we were quite clear that our guidance of 21 to 23 would come from the various cost optimization programs we had. The industry faces the usual cost pressures every year, which is, of course, discounts from clients, which, of course, come and hit straight away on the top line, and, of course, the compensation hikes. But we've got our execution machinery very, very right in this quarter. We've got the utilization up, so that's the first thing which flows to the bottom line. We've got our on-site mix coming down, so we're getting more work offshore to India. We are working on other programs around automation. That's the continuous engine we have. We continuously take out 2,500 to 3,000 people from our fixed price projects and plow that back and give that part of that money back to the clients. We are working on other issues like digital pricing. I think this is a new area we are looking at, is how do we price digital services and command a premium from our clients. So we have a very strong cost optimization, nearly 18 tracks which we have. It's run by a senior resource in the company. And from a quarter-on-quarter basis, we've gained about 110 bips of our margin improvement has come from operational parameters and cost optimization, which we're working on.
Next question is from CNBC.
Hi, this is Mugdha. Firstly, great numbers, so to start off with that. But the street was estimating that you would also up your upper end of the guidance as well by about 50 basis points. Any reasons that you've held back on that? Are you a little concerned about the second half of the year? And Salil, that's for you. To Nilanjan, I just wanted to ask you about the margins. The margins have improved, but where do you see margins for the whole year ending at in the whole band? And, Praveen, if you can just tell us about retail. Retail looks a little weak. What is the outlook there? And, of course, attrition has come down. So if you can just throw some lights on that. And, Salil, one more question to you. If you can break down the organic BFSI growth apart from Stata for us.
So on the guidance, the good news is we've increased the lower end of our guidance. So instead of 8.5 to 10, we are 9 to 10. We had, from the start of the year, a view about the year, and every quarter we have strengthened the view that we have for the year. So there's no change in that. We know that seasonally the second half is normally weaker in our sector, and that's the normal sort of seasonality of the business. But overall, our deal pipeline remains strong. Our Q2 numbers are very strong, with 6 of our 7 sectors really recording double-digit growth. So we remain quite confident that our clients are looking at what we are providing to them in terms of digital transformation capabilities. The only caveats we mentioned were the ones I shared before, specifically with respect to the European market or capital markets, or at least in last quarter, some elements of manufacturing. On the financial services and others, Praveen will address that with the retail question itself.
On the retail front, obviously this one sector which is closely linked with the consumer sentiment, with all the overhang of macro, talk about macro trade wars, and to some extent some reduced consumption that people are seeing in some of the global markets. Obviously the spend in retail has come down. We had a fantastic year last year in retail, but in the last quarter and this quarter we have started seeing some softness and slowdown. So this volatility will probably continue for some time till the macro situation improves. Because as I said earlier, this is a vertical which is probably very closely tied with the macro sentiment and so on. On the financial services, as Salil said, we have had a decent run so far. We have had last 2-3 quarters of double-digit year-on-year growth. But we do continue to see some weakness in some of the European banks and capital markets. And we also have to watch out for the seasonally slowdown in the second half. But we have a diversified portfolio. We have done well based on the past deal. So we remain optimistic, but we just have to watch out for the seasonality in the financial services. On the attrition, attrition has come down. The voluntary attrition is under 18%. It's come down. And we have, over the last couple of quarters, we have focused a lot on coming up with a new employee value proposition, several interventions. So we are really focusing on enabling employees, engaging them better, and rewarding them. So there are multiple interventions towards this. And slowly we have started seeing results. And this is something we need to continue to work on. No, normally, I mean, we don't really give that breakup.
So on the margin question, like I explained, we had 21 to 23. At first half, we have now at 21.1. So we have entered the guidance band. I think this is a good platform for us to build as the year progresses and to see progressive growth on margins from here. So we remain committed to the 21, 23.
Next question is from Bloomberg.
Hi, Praveen, Salil, and Nilanjan. So I want to ask you about the US market, where you get almost 2/3 of your revenues from. What is the macro looking like? First question. Second question, I really do want you to give as much more detail about BFSI deals as you can. That accounts for almost 1/3 of your revenue. So these are two real key components of Infosys, and I would love for you guys to tell me more.
So the US market, I think the overall situation in the US market, the GDP growth is still quite good. If you saw the numbers for last quarter, there's obviously an ongoing impact with whatever is going on with the macro in terms of trade discussions, and potentially some impact that might have on manufacturing clients. On the other hand, we see a lot of positive discussions, whether it's with telco clients, high-tech clients, utility clients, energy services clients. So overall for us, we remain optimistic. If you look at our growth year on year for the US North American market in Q2, it's again well over double digits, and we remain quite bullish about the market. In terms of FS and the details, I think I would echo the points that Praveen just shared with you. There are some areas we look at, for example, in the European banks where there's some slowing. We've seen this with capital markets. Typically in Q3, we'll end up seeing overall the seasonality which come from furloughs, but there is nothing sort of materially new in that situation that we see. Having said that, there's a lot of work that we need to do in making sure we execute against all of that, and we remain committed to, and in fact, we're increasing the bottom end of our guidance. So that should give an indication of how we see this year playing out.
Next question is from Mint.
Hi, Ayushman here from the Mint. Can you give a sense of the digital deals, right? What are the size of the digital deals, and also what kind of deals are these? Are these large-scale digital transformation deals, or is it just some automation here and there? I mean, just give me some sense of that.
So the digital portfolio again has had a good growth in Q2, 38% overall year on year. It now also comprises just over 38% of our business. So it's looking really robust. A couple of examples. We had a deal, for example, which was focused on what we call user experience, which is really the front end of our digital thinking. There we work with a large confectionery company a global confectionery company, where we've redesigned completely how the experience of their end user is with how they interact, how e-commerce is done through that. And a lot of that design was very personalized, very intuitive. And this is a large platform in which we've built this. Another example is on the cloud, where we worked with one of the large 3 providers for a large US company again, where we built a public cloud transformation program that the client is going on. And here we are partnering with them to bring services which are existing services of the client, plus new services which we are helping them develop, which are more cloud-first services. Many of the deals that we see are large transformation deals, which are modernization deals, in which digital is a strong component of it. So the good news for us is digital is becoming more and more central to many of the new things that we're doing with clients. And we see that the investments that we made, which were last year, are starting to be relevant for how the clients are looking at us from a digital perspective.
Next question is from Hindu Business Line.
Hi, I'm here after about 3.5 years. And one thing that I notably find is that your margins have gone down, operating margins have gone down substantially. Praveen, tell me why this is happening, because you used to be the industry bellwether when it came to margins, and you prided yourself on, profitability over growth. So is it a growth story now more than, margins, or what?
The beginning of last year, when we started the Navigate Your Next Journey, we had clearly said that there is a lot of opportunities in the digital space, but that means that we have to invest, we have to build capability and competency. There is a small window for us to capture that. And we also said it's a 3-year journey. We are just 18 months into the journey. And so we have done significant amount of investments. We have done localization. We have invested in living labs. We have increased the sales spend. We have hired people with different capabilities and so on. So multiple level of investments to build the capability to take advantage of this one. And that's reflecting in the kind of growth that we have seen in the last 3-4 quarters. We have said we have given a guidance of 21 to 23%, and that's what we are confident of. We don't want to comment on the future, but at this stage, for the rest of the year, we are comfortable with what we have said. The focus is on investing. I mean, it's not. I mean, obviously, growth is very important, but obviously, we have to have a purposeful growth and a profitable growth. So we are not really diluting the focus on profitability, but we are making sure that we are doing the right level of investment to secure for the future.
Next question is from Business Standard.
Hi, great set of numbers. This is from Business Standard. I want to understand 2-3 things. Firstly, yesterday there was the commentary from the market leader. I don't want to compare it, but there is a sense in the market that the deal conversion, pace of deal conversion is being slowed down due to the macros. I just want to understand that whether Infosys is facing such kind of problem, because TCV is fine, but how much of the deals are actually being converting into revenue is also important. I wonder. And secondly, I want to understand, are you facing any client-specific issues in any of your vertical at this point of time, or will you face such kind of issues in Q3 and Q4?
So on the deal conversion, we've had, as you saw, $2.8 billion in large deals. We've had 11.4% growth in Q2. We cannot get those sort of outcomes if the deal conversions are not happening well. So for us, deal conversions are happening well. Having said that, I shared a little bit earlier what our view on the macro is, which still holds, but it's not, at least for us, anything with deal conversions. In terms of client-specific issues, we didn't call out anything on Q2. For Q3 and Q4, we'll see as the quarters go. There's nothing today that we'll call out for Q3 and Q4, but we've not called out anything for Q2.
I want to understand how much the cross-currency has actually helped in your margin improvement. And as far as the H1 margin level is concerned, is actually at the lower end of your guidance. So I think our fellow colleague has also asked that whether is 21-23 band within that, will you end up FY20 on the low band of the margin, or can you give such guidance? And my last thing to Praveen sir, last quarter you spoke, I think Infosys for the first time gave some kind of threw some kind of light on the involuntary attrition. What exactly happened in Q2 as far as involuntary attrition is concerned?
So on the cross-currency, actually, we've taken a hit this quarter. So while we got about a 30 basis point improvement from the USD INR, but we actually got a hit of about 15 bips on cross-currency because the pound and the euro depreciated against the dollar. So whenever that happens, you also see the top-line revenue reported growth for the industry coming down. So we had about a 15 to 20 bips hit on the cross currencies and about 10 bips on our revenue hedge, which we had. So actually currency didn't come to us as that a full benefit. Coming back to the margin, like I said, 21 to 23, we are at a H1 of 21.1. And from here, definitely we should see ourselves growing. So I don't want to say where we will end up, but definitely it's a platform. We have a very robust cost optimization, cost takeout plan. And we remain confident for the rest of the year.
See, on the attrition front, on the tech services, we said attrition is 19.4% as compared to 21.5% the previous half. It's both voluntary and involuntary. And if you look at only voluntary, we said it's under 18%. So that's the data points. And increasingly, we are seeing everyone talking about tech services and voluntary attrition. So over a period of time, we also want to do that so that we are consistent in metrics similar to what others are reporting.
Next question is from Cogensis.
Hi, sir. Nikita from Cogensis. So I want to understand if you're seeing the double-digit growth momentum sustain in the second half, considering it's a softer period. And if you could share a little more about how you expect the European region to perform.
So for the growth on double digit, our view is very much focused on what our guidance for the full year is, which is 9% to 10% for the full year. We've had 11.4% growth in Q2, and we remain confident that we'll meet this guidance that we've given in terms of growth. In terms of the European market, what we shared earlier, there is some slowing in the European economies. Overall, we see the macro there a bit slower, but there are some segments which are still doing well. We see good strength. Again, for example, in the telco segment or in the energy utility segment. We called out that on the banking side, Praveen shared with you, we have some concerns on the European banks. And that's something that we've shared before as well. But that's broadly how we see the European picture playing out.
Next questions from Business Today.
I have three questions. One I just read that you're going to be you're going to be absorbing the Calidus back into Infosys. There's a business transfer agreement. So does it mean that there's absolutely no prospects for those business to be sold out, and also some bit of sense on how many people were there in both those companies, how that kind of an impact? Secondly, I want to understand, since Nilanjan mentioned that some of the on-site work is being brought back, that vis-a-vis your localization plans, just to understand, where is it heading?
So on the merger or the absorption, the approach we've taken is we've made, as we shared with you a few quarters ago, we've repurposed what we're doing in that business, focused it very much on where our digital growth is going and where some of our clients, especially what we saw in consumer products and retail, looking at that. And as a consequence of that, we made sure that it's combined fully within the Infosys organization. With that, we'd anyway stopped any discussion about any transaction a while ago when we had started to repurpose it, and that's what happened. We've not discussed or disclosed the headcount in that situation at all. The second question?
Yeah, so the on-site mix is just a percentage of overall. So as our volumes, of course, grow, we will increase numbers in the US as well. So this is just a mix in the overall percentage. The second thing is localization is also from clients. We take out work and put them into our hubs as well. So most of the work today is sitting in client premises. Some of that work we will take into the hubs, and that's the way we will populate the hubs as well. So it's a combination of both. So the whole idea of if the hubs actually was firstly to get these innovation labs centered around the hubs where our clients can come. We can create a pyramid in the hubs as well. So one of the things was get freshers, which was a whole thing is looking at the talent scarcity in the US. How do we take freshers from college, from community colleges, and build a pyramid? And that is also helping our cost structure as well, as you've seen. So I think that's one of the key areas we got, and also getting the local hires, which was one of the issues 2 years back, which was very in the limelight. Today, we are close to a 50-50, base versus deputy sort of a mix, which is something we are quite comfortable with. And I think the hubs is only going to increase that percentage.
Next questions from the Economic Times.
Hello. Congratulations on the good set of numbers. First thing, to Nilanjan, you talked about digital pricing and commanding a premium over that. If you can explain how that's going to work out. And the second question is to Praveen. How is the India business doing as of now? Do you foresee any sign or do you see any signs of slowdown as of yet?
Yeah, so I think our digital margins, even today, if we see our overall margins, digital are higher than our core business. So that's something we already know. I think the way we repurpose our digital talent and looking at the scarcity, we think there's an opportunity of how to price this scarce talent, right? Depending on skills, depending on experience, depending on what sort of clients they work in. And I think if we can even get a percentage, that's a percentage of margin. So I think that's something what we're looking at, how we can look at this digital skill set which we have, and are we actually pricing them correctly, and are we leaving even a cent on the table, which is a lot.
See, on the India business, I mean, it's a very small percentage of the business, and as we have said, we are very selective in what we want to do. So, and from that perspective, we are not really seeing any slowdown, because we'll continue to be very selective in what we want to bid for and what we want to execute.
Thanks.
Next questions from Reuters.
First of all, congratulations on the numbers. And I had two questions. One was, we are seeing a slowdown in Europe and North America because of the trade war and Brexit and all of those things. But you have reported like better than expected results compared to your rival. So I was wondering what was it that helped you achieve this kind of a result this quarter? And the second question is, I was also wondering if the raise in the lower end of your guidance was because of the strength in the US market that you're seeing, as you yourself pointed out.
So I think what we are seeing is the focus that we've had on our digital investments, the approach we've taken to localization, the approach we've taken to reskilling, and the real attention to all the automation work that we're doing with our clients. That's making it very relevant for how clients are viewing Infosys. And that's really what's driving this growth that we saw in Q2, for example, and also helping us to be confident to raise the lower end of the guidance. As you know, from the start of the year, we shared some view on the guidance, and we have a view internally of how the quarters evolve. And we are comfortable that that's how it's playing out at this stage. Of course, from a seasonal perspective within the industry, typically the second half is slower, especially Q3 because of the holiday season and so on. But outside of that, we see a very good large deals win momentum with 2.8 billion. So we see our clients really trusting Infosys and making Infosys part of their decision making. Very much the first company that they think of when they think of all these digital things and when they think of automation. And also we see that our pipeline today is still quite robust at a large value. So we see those deal conversions and new deals still coming into the pipeline. So the US market, what I'd shared a little bit earlier, of course, there's a macro situation which we need to look at and be cognizant of. There's a trade wars situation. There's a situation where we see some disruption which are coming in some sectors, but equally we see strength, as I shared earlier, in energy, utilities. That sector is really doing well for us. Again, a double-digit quarter, and we see good momentum there. We see good momentum in a high-tech telco business. So we see lots of areas where we think that the difference that we are making is going to continue to help us as we go through the rest of the year, keeping in mind the overall macro and some of the comments we'd made about financial services earlier.
Next questions from Money Control.
Congratulations again on the good numbers. So I have a couple of questions. So your BFSI has been growing well, but there has been some softness. Could you tell me where is the confidence coming from? Where is the growth coming from when your competitor has reported quite some weakness in the BFSI sector? I would like to know where is the growth coming from for Infosys. And other one is about, I saw that your core has been coming down consistently and your digital has been growing. But is this being offset by the digital, or is there a gap in between? Are they both growing in tandem? Your reduction in the core is being offset by the increase in your digital business. And compared to Q1, your growth in digital has come down. So I think in Q1, the growth was 41%. Now it has 38.4%. So I would like to give me some insights on that as well. And the other one is on the hiring. If you can give some color on the hiring and involuntary attrition, you had mentioned that the voluntary attrition is about 18%. So I would like to know more details about the involuntary attrition. And the other one, the last one, is about the Brexit impact and your recent Irish buy, the contact center in Ireland. There have been some reports on that. So your confidence in the telecom is in part aided by this new buy where the HTAC has a good presence in the telecom sector. If you can give some insights on that as well.
Okay, let me start through some of the questions as I recall them. I think on financial services, there's been, as Praveen shared, a very good track record and momentum over the last several quarters. So that's what gives us confidence for the overall guidance that we're giving, part of which is financial services. So financial services, we shared, we think there are some concerns that we see in some components and not in the other components of financial services. And we see some strength which are in other sectors. As a composite, that's where the confidence comes for the company and the guidance that we've increased the lower end. So we are not becoming very specific in terms of which clients or which regions. We've simply called out where we see some concerns. Nonetheless, overall, we are remaining confident for the overall company guidance that we've given, which is 9% or 10%. As I walk through some of the other questions, I think the question about digital and core, we want to showcase that more because we want to clearly show our investments in digital and how they're performing. I think our story on automation and the capabilities we have are actually helping us to maintain a good presence in the core businesses. While the degrowth is very small, the real story there is the automation that we have is allowing us to become more and more relevant for our client portfolios as we go through the core. I think in terms of the growth of digital in Q1 versus Q2, our view is, and we shared this a year and a half ago, this is a very large market, about $160 billion market. The market's growing at 15%, and our target is to have market share gains in that market, which means anything above 15%. This is also a new business. So some quarters it might be a little bit high, a little bit low, but overall, as long as we're gaining market share, that shows some strength for us in that market. I don't know if I missed any. Irish, yes. So there, it was a business transfer situation where we've taken over some of the work that was going on there. That's not the reason for our strength or the confidence of telco, but of course it supports the confidence in telco.
On the attrition front, as I said earlier, the numbers are 19.4% overall attrition, IT services, and under 18% voluntary. So there's nothing more I can talk about it. On the hiring front, I think we continue to hire. This quarter, we added about 14,000 people. We had about 6,000 people, trainees join in India, and about 700 or 800 people outside India. And rest were laterals both in India and abroad.
Next questions from Times of India.
Hi, sir. Shilpa from the Times of India. Can you give us a breakup of your TCV? How much of it is renewals and how much of it is new deals? And can you also call out the TCV to the revenue ratio?
See, on the renewal thing, this quarter a significant, I mean, we don't typically call out the exact number, but a good percentage was renewals this quarter. So that's the thing. And what is the second question?
On the TCV to the revenue ratio.
Conversion.
We again don't give out the conversion ratio, which I think what you're looking for is how much that TCV convert. What I can say safely to you is we don't count a lot of 10-year deals in this TCV, if that's what you're asking. We have really low duration deals which we put into this, and that's why we have some level of confidence of the conversion.
Right. So there's been momentum on the digital side, but it's not really reflecting in your revenue per employee. That's been more or less flat for many quarters now. So how far till we see some sort of a momentum pickup even in your revenue per employee metric?
So there, I think the way I would look at this is the big move we've made is on our operating margin from Q1 to Q2. And we see a huge strength in that because that shows an extreme level of discipline, how we executing our business, plus a strong confidence that we are in the guidance range of what we had said at the start of the year. On the RP, there are many pluses and minuses that go into that calculation, but we remain very confident that our digital RP is looking more and more better. But within the core, there are discussions which relate to how the start of the contract looks like, how the discounts look like, and that sometimes colors what those numbers look like.
If you can also give us a color on the subcontracting expenses, how that's playing out, because in the US, there's been a groundswell from all these subcontractors to demand healthcare benefits on par with other full-time employees. And there's been a lot of unionizing in the US. Will this, going forward, increase the cost for you? Not immediately, but long-term, there could be some impact on your cost structures.
On subcontractors, actually, we've had a very good progress on how we look at the subcontracting situation. First, it's an integral part of our business. It's not something that we want to have completely disappear. Second, we have now found a way where we know how we can control some of that spend in the short and medium term. We've also put in place approaches where some of that becomes in time converted to our own employee cost structure base, which again helps us in the margin. Our view is in the medium term and in the short term, we know how the subcontracting costs can be addressed. And overall, it's what Nilanjan shared earlier, is part of our operational discipline to ensure that our margin gets all the benefit it can from making these steps.
And on the margin front, how much of it is a currency kicker? And secondly, would you stand to benefit from the reduction in the corporate tax?
So as the margin one I mentioned, we got from the USD INR, we got about 30 basis lift, but all that was washed away on the cross currency we lost because of the euro and GBP depreciation versus the dollar and the currency. So at net at the quarter end, we got nothing from the currency. Coming to corporate rates, our India tax rates is marginally below 25. This is for Infosys standalone, of course, because that's the way we look at taxation. So we think we'll have to watch the space carefully and at what time and space we decide to move over. But at the moment, we think we're comfortable with the current tax regime.
Next question is from Deccan Herald.
Hi, how are you guys? So basically, I have a couple of questions here. So the first, sorry to go again on that question. The core has been declining. Is it a deliberate kind of a move? Because at the end of the day, digital offers you a lot of premium and higher margin. And do we see lesser dependence on the core and, I mean, reducing your dependence on the core over the time? And it goes in line with Salil's vision for Infosys, more dependence on the digital revenues. Second part of the question, while the streets expected around your upper guidance to go up as well, to be revised as well, but you have not done that. Is it the conservative approach or the uncertainty because of the global macros? Are you looking at uncertainty in the second quarter? The third question that I wanted to ask is, see, now in 2014, Vishal had set a Vision 2020 in which the revenue per employee was said to be $80,000, if I'm not mistaken. But over the time, we have seen it is hovering around $54,000 revenue per employee and stagnated, and the margins are nowhere near to 30%. It's somewhere 10% down that. So do you think in the hindsight that Vision 2020 was basically hyperbole?
On the first question on the core is absolutely a critical part of our business. So what we want to do is, with digital, we really want to be the partner with our clients as they go through the digital transformation journey. But we also want to help them on the core because we have extremely strong capabilities in automation, which we believe are better than anyone else in the industry. And when those are used with our clients, they can get tremendous benefit from it. Part of it they keep, part of it hopefully we get to keep it. So the reason for showing you that stat is just to be very clear about what we are doing in that business, but it's not in any way that we are de-emphasizing what we're doing in core. What was the second thing? Guidance. So we are extremely positive, and that's why we've raised the lower end of our guidance from 8.5 to 9. And we've kept the overall guidance from 9 to 10, which is a very strong guidance given what we started in terms of the year. And given that typically we see in the second half the seasonality kick in. Of course, as the quarters go, if things are above that, we'll see how it goes. But that's the guidance that we have for now. In terms of, what was the? 2020. No comments on that.
Thank you. With that, we've come to the end of the.
Seeing double-digit growth. So is there a pain point in retail? If you look at retail, there's a...
I think I already responded. Obviously, retail is one sector which reacts very quickly on real time to the macro and sentiment. So given all the macro concerns and sentiments around trade war and other things, so there is obviously impacting consumption. And again, when you look at some of the global markets, there has been slowdown as well. Some of the markets like China and other places. So this is actually impacting retail. And this sector is obviously, I mean, it will continue to be volatile. So when the sentiment increase, consumer sentiment is positive, then you see a lot more sales happening in retail and vice versa. So right now, given all the macro and other concerns, in the last couple of quarters, we have seen softness. Difficult to predict when things will improve.
Thank you, everyone. I would request you all to join us for high tea outside. And friends from media who would like to listen to the earnings call, please move towards Building 12. The carts are arranged outside this building. Thank you.